Welcome back. The Nifty is in that zone 16,650 now, 400 points higher. So at high point of the morning, Bank Nifty is up 1,200 points. The mid cap index is up 4%. The small cap index is up 5%. So today you are seeing a powerful short covering, bit of a move. Let's see if that sustains. For now, it's given indication that it is sustaining. Rupal Agarwal is joining us now, Senior Research Analyst, Asia Quantitative Strategist at Bernstein. Rupal, good morning. Thanks a lot for joining us. How are you reading the current situation? There's geopolitics on one side, and there's, of course, inflation concern on the other side. For equity investors, how should they approach a market like this then?
I think, where we are currently, it's a very interesting confluence, I would say, of a lot of factors which are playing together. So even before the geopolitical risk actually escalated, we were already seeing risks from policy uncertainty being very elevated. There was a risk of inflation as well as, very aggressive Fed tightening. So I think geopolitical risk is just sort of added to that. And we saw, how the markets, had a knee-jerk reaction yesterday. But having said that, I think it's very difficult to sort of time in or, play the geopolitical risk. The best way, I think, to navigate such markets is, we think, managing the volatility of the portfolio. So, there are so many uncertainties out there, but what is clearly become more, clear is the fact that markets are likely to remain more volatile, and in fact, both on the upside and the downside, and hence managing volatility or searching for, opportunities which are more low volatility, I think is the best way to, navigate these situations.
Okay. Well, Rupal, what's the expectation of foreign funds? Where does India figure in terms of valuation, volatility? We have seen many of them quit India in a hurry this year.
Yeah, absolutely. And in fact, this is what we expected, since the beginning of the year, because India is one of the more expensive markets across EM equities, even, relative to most of the DM markets. So I think,
but it always was, wasn't it?
It always is, but relative to its own, valuations, it was 2 standard deviation above the historical mean at the beginning of the year. Of course, that has come down significantly. We are now roughly around 1.3 standard deviation. But if we look at some of the other markets, which have been correcting for almost 6 months, and I'm talking more about the Asian markets, I think there are more opportunities from a valuation perspective, and the valuations clearly are not looking as stretched as, in India. And in fact, if we look at the expensive side in India, that's still almost more than 2 standard deviation above the longer term mean. So yes, I do agree that, in certain areas within India as well, there are opportunities which are emerging, but in my mind, I think it's too soon to expect a lot of FIs to, return aggressively because the valuation concerns still persist.
So Rupal, in terms of sectoral view for India, the last 2-3 years, it's been all about IT. But of late, we have seen some shave off in valuation. But do you think that could be the hiding space once again?
I think tech, I would be very selective. So large cap techs, yes, are still, somewhere to hide because they always are low beta kind of names, still more high quality, high free cash flow generating names. But I think apart from tech, we are becoming more, constructive on the other defenses like staples, pharma, even a lot of bigger financials. They generally tend to be, lower volatility, are higher quality. So a lot of those other pockets in the market are also starting to look attractive.
Okay. Well, the argument of many of the analysts have been that because of this K-shaped recovery, it's not staples but consumer discretionaries that will continue to do well as the economy recovers. But you still prefer staples?
We do prefer staples, and I completely agree. I think even if we look at the numbers, staples is, and in fact, even pharma for that matter, is one of the least liked sectors right now. And I think that's, to us, looks quite interesting, right? So if you look at from the defensive pockets in the market, which either you look at it from low volatility or high quality, these have never been so less concentrated or crowded, which to us, is a very strong positive contrarian signal. On the discretionary, we still have some selective exposure, especially on the auto side. Because we do think that there is still an angle of inflation and US yields rising, so it's too soon to completely move out of cyclicals. So some bit of exposure into energy, materials, and consumer discretionary still makes sense.
Okay, a larger question, Rupal, on the overall state of the market. How can we compare the current phase to 2004 and 8, which is what a lot of people do, even though the starting valuation point might be different? But in terms of, when the market did really well, we had very strong economic growth, and while the Fed kept raising rates, markets kept going higher.
I think we're in a slightly different scenario. Last time I was on the channel, I did mention that, this entire comparison of the rally being very similar to 2004-7. In my mind, there are a lot of things to play out for the rally to continue, especially, on the earnings side. Valuations we've already discussed, still look stretched. And we are seeing still limited support from, earnings. So overall for Indian equities, if we look at the earnings revisions, is still very, very neutral. And we're not really seeing a very strong tactical support from earnings. So we would still wait for some, further enhancement there to call it, a multi-year bull run. In my mind, I think if I look at from a broader macro perspective, this looks very similar to, say, back in, I would say 1999 or 2001. There were only two instances historically when we were in a very similar elevated policy uncertainty, elevated geopolitical risk, which was back in 9/11 and the Gulf War II. And both of those time periods, of course, did not play out well for the markets globally. And there was, again, increased volatility. And that's why, we think that this is probably, one needs to manage the volatility, hide more on the defensives in the market, rather than, being quite aggressive. So it's clearly not a risk on rally that we are expecting.
Okay, thanks very much, Rupal, for joining us. It's always a pleasure speaking with you for that perspective.